I'm Charlotte McLeod with investingnews.com, and here today with me is Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com. Thank you so much for being here. Great to have you.
Thanks for having me, Charlotte. Always a pleasure.
Yeah, and our first time in person, so very excited to actually see you in the flesh. And we're here at VRIC, and I'm pretty keen to get your thoughts on this conference because you're so focused on the charts, and I feel like this is an event where there's a lot of talks about geopolitics and the news cycle. So what are your impressions?
Yeah, it's a very different group that are energy that I'm used to. I'm all about the charts and technicals, and everyone here is very into stocks and fundamentals and drilling and all that stuff, right? It's all into the resource space. So it's great. It's a totally fresh view on a lot of investors and what they're investing in the resource space. So it's good to talk to everybody and see what's going on.
Yeah, and on that note, so I know that you've already presented on stage today, and unfortunately I've been up here locked away, so I didn't get the chance to hear what you had to say, but maybe we could start by going over the message that you brought to people here.
Yeah, so today I was trying to share with everybody a new way to invest, a different way, which you and I have talked about before. I call it asset revesting. So it's not buy and hold, but it's not active trading. It's really just finding a way to move your money into an asset class that is rising, only holding stuff going up. So if something stops going up, we move to a different asset. And so the big message today I was trying to share was there's 3 investment strategies that most people do, all of them, and they're all very dangerous. They're high risk, low return. And so the first one is the buy and hold strategy, diversification. And I show the volatility of buy and hold is a guaranteed roller coaster. You're going to go through a bear market or multiple of them, and it's pretty devastating for most people. And the problem with the buy and hold is you're diversified. So you have a bunch of your portfolio in stocks, a bunch in bonds. And what happens when you're diversified is you have half your portfolio is winning, the other half's losing. And so your winners are killed by your losers, and you end up with a really poor, low average return. And that's the buy and hold. That's why it takes 40, 50 years with the buy and hold to make money. So that was the one of the strategies that I talked about, the weakness. The other is falling in love with stocks. And people have owned marijuana stocks, they've owned gold and silver stocks, and you name it, all kinds of different stocks that go down and never come back, or they take a decade. And so I'm not a fan of falling in love with an asset. The stock market is always trying to take your money. I'm like, get in when there's a trade and a trend, follow it, get out when it's not favorable. And then the last one is the power, the dangers really of dividend stocks. And most investors have a ton of dividend stocks. The average investor in the United States is 45 plus. They're close to retired or retired. And the number one strategy they're told is to buy the big blue chips, buy dividend stocks. They're solid, they're big companies, but they actually carry way more risk, downside risk, than the stock market itself. So for example, in the last few weeks, the stock market is down about 4.5%. The dividend portfolio is down about almost 10%, 9.5%. So these so-called safe, low-risk stocks carry twice as much volatility. And during the COVID crash, the stock market fell 35%. Dividend stocks fell 48%. And poor retirees and investors took the biggest hit, and here they think they have the best opportunity or the lowest risk. But the problem is dividend stocks don't rally when the stock market rallies. They kind of flatline. So I was showing the comparisons on the chart. So when you see the visuals of these 3 strategies compared to something that rotates into a new trend, gets out of the trend, and moves into a different asset, it's dramatically different. And unfortunately, we're going into a very difficult phase. I think 2025 is going to be very, very crazy for all asset classes. And if you don't have a strategy, the market is going to do a lot of damage to people. And there's more people close to retired or retired right now than ever before. And the market is great at hurting the maximum amount of people. So I think, that's my whole message is how can you protect yourself?
Yeah, well, and maybe we should talk a little bit more about your strategy for these circumstances, because I think you just debunked, 3 of the main things that people are told often.
Yeah. I mean, I was in fundamental stocks back in early before 2000, and I owned the best companies. They had to have quarterly growth for like a year, and the tech bubble came and they blew up. The stocks got cut in half. They got cut in half again, and I lost all the money I'd made up to that point. And that was when I realized, okay, fundamentals don't work. If a price is going down as an investor, we're losing money unless we're in favor of the trend. So I moved to technical analysis, which is what you and I usually show the charts. And the technical analysis allows us to identify trends when a new trend is started. If the underlying strength is there and it looks like it's going to be a strong wave, then we invest into that asset. Could be the stock index, could be bonds, a currency, a commodity. and we ride that trend. And then when the technicals start to weaken, we move out. And all the traditional investment models don't do any of that. They really expose you to all three things, and you just carry a ton of risk.
Yeah, and maybe we talk a little bit broadly just to begin about trends you are riding in this year that's probably going to be quite volatile.
I think the big trend right now, like the stock index gave us a sell signal, not a sell short, but just to get out. The stock market is not favorable. And this happened a few weeks ago, so the market's been really trading sideways. So we've moved to the US dollar index. It's a low volatility play, really boring. A lot of people don't even think it's a trade. They don't believe it's a trade. Just because it's, you're buying into a currency, but it's one of the most powerful tools. When the market falls apart, if it was to sell off, the dollar can do very well. And it's not volatile, so you don't have to sweat and worry about it dropping 5 or 10%. A big move in the dollar is like 2.5%, 3% in the dollar index. So it's a nice low volatility play. I think people need to realize sometimes the best play is really doing very little, either cash or the dollar, and that's what people need to focus on.
Okay, and yeah, as you had outlined, when you're doing this, you're not diversifying all over the place. So this is the main thing that you're doing currently.
Yeah, so this whole strategy is what I've been doing since 2001, and I really just invest and manage my own capital, and I share it through a newsletter. So people just copy what I do. So I'm not dishing out trades. I'm not trying to hook people into anything. I'm just like, here's what I'm doing, and this is how we're going to navigate the chaos between all the different things. And I cover precious metals. I cover real estate. There's all kinds of opportunities coming, and those are all things I invest in as well. But more or less, this is what I do. This is what I live and breathe. And it's not about trying to make the most money. It's about trying to preserve capital and just consistently grow our wealth without worrying about devastating values.
Yeah, very, very scary to talk about. So we'll go into some of our usual topics now, I think. I definitely want to bring up gold as usual. So we actually last spoke pretty recently, I think about mid-December. And you told us at that time that we're probably heading into a consolidation period for the metal. And, it's gone higher since then, but no wild breakout. Mm-hmm. So are you still looking for that consolidation period for gold?
Yeah, gold's still pausing. I'm neutral to bullish on gold. I still think gold has potential to make some new highs. I think it could actually run up based on the charts to maybe 3,050, which is a half decent run from where it is. But overall, I think the majority of the move in gold is kind of over. You and I have showed this on charts in the past. Back in 2007, we saw gold have a big move up, and we've had a similar type of move now. And so I think you can still hold gold. I think it's still going a little higher. But overall, I don't think it's a new trade. I think if anything, you need to protect yourself. If it breaks the lows that we saw about a month ago, I'd probably be moving out of gold if you were still in it, because I think it could actually have a fairly significant drop.
Okay. Good to take a look at gold. And I think last time you had said kind of a similar situation playing out for silver. Is that kind of still the case?
They're pretty much the same trade.
Yeah, they're the same. Okay, so I think it's a really good time to be checking in with you, because also during that December conversation, you talked about the end of January as a time that we really needed to pay attention to when it comes to the stock market, because if we get a higher close in January, usually it's a positive year for the stocks. So you've kind of shared what you're seeing already. Was there anything you would expand there?
Well, I think we've got Trump moving in. I think there's going to be he's like a wild card, Trump card, if you play euchre. There's a lot of wild cards. January is naturally a volatile month for stocks. We see big rallies and drops. Where the market closes in January, if it's positive, it tends to be a strong year. If it's a negative close for January for the S&P 500, it's usually a bearish year. So I'm kind of waiting to see what that tone is. But then we have all this stuff going on with Trump, and who knows if it's going to juice the markets higher. We are very close to a new buy signal in the stock market. So if for some reason everybody rallies up with Trump in, we could be long equities again. But they could roll over and die. And that's why our whole strategy right now is saying get out and just move to a currency, because there isn't real certainty. There isn't a real direction. When you lift the hood to the markets, it isn't screaming, move your money here. It's saying it's all over the place. It's like, just step back and let this thing figure itself out. The charts paint pictures, and when you can read the pictures and understand what's going on behind them, then you can take action. But right now it's just a messy picture. There's no real confirmation of what side to put our money on.
Yeah, and it's a tricky time just for the audience. We're talking on the eve of Inauguration Day, so we really don't know what's going to be happening, and hopefully we'll post this quite quickly, but it's bound to be uncertain. So also in December, we talked about best performing assets for 2025 potentially, and you'd mentioned TLT. So this is a long-term treasury bond ETF. And there's been a lot of talk about what's happening with these long-term treasuries. So can you unpack what's going on there for people who might not be familiar or understand what this means?
Yeah, so I think eventually rates will fall. I think when chaos hits the markets, equities start to sell off, I think the Fed will start cutting rates. We have Trump and tariffs. I don't know how that's going to implement things and what we're going to see with inflation. But eventually, when things get ugly, we're going to probably see interest rates get slashed. If rates go down, bonds go up. I'm not a huge fan of bonds yet. They're still in a long-term downtrend. They haven't actually carved out a bottom. So I'm not interested in them yet. But once they put a bottom in and say the music does come to an end with the equities market, the economy stalls, bonds should rise from the ashes. And I think they'll have some pretty good upside potential. So I like those. But until bonds are favorable, the US dollar index is the kind of the best play. It's low volatility. It tends to do well in uncertainty. And it's kind of that low volatility play to get into.
Yeah, I definitely can see you're on theme with that one here. Okay, so we're setting Trump aside a little bit just because there's so much uncertainty. And I know that you're all about tuning out noise of what's going on, but because we're here at a Canadian event and we've got some changes coming about in Canada as well, we've had Justin Trudeau resign. Probably we're heading toward an election sooner than later, perhaps. So does that change your approach in terms of anything that you're doing? Does it make anything in Canada more or less appealing to you?
Not really. Like news and political stuff doesn't weigh in on anything. It has zero input to our strategy, but it does say there's a lot of stuff coming down the pike and there's probably going to be volatility. So I'm expecting all of this craziness to move all kinds of assets. Like who knows what all these things are going to do, right? Everything's going to go haywire. And anybody who says this is going to happen, it's not true. Like none of us know what's going to happen. The key is follow price and follow it as close as you can, not try to predict what's going to happen. Because if you try and predict, you're going to lose 50% of the time. That's just the way it works. So knowing all these elections and what's going on in Canada, we just have to be aware the Canadian dollar is going to be volatile and commodities are going to be volatile, stock market's going to be volatile. You just have to be ready for a wild year.
Yeah, this is kind of the answer I expected, but I think it's good to go into. And I wanted to use that as kind of a bridge into oil and gas, which I don't remember if we've spoken about this market before, but I'm curious what you're seeing there coming ahead.
And the energy stock space, typically when we get to the end of a major stock market cycle, we've talked about gold. Gold comes to life and does very well. Energy stocks generally do the same. And energy stocks have been on fire. They've been moving up for months, really for the last year. Oil prices have been going down, trying to find support at about $65 a barrel. So there's a divergence. Typically, when energy stocks get up here, we see them have a huge correction. So I think we're just kind of waiting for the economic data to stall. I think we're going to see oil eventually break down. And energy stocks are going to be one of the worst hit in the near term. So I'm pretty bearish on energy stocks. And it's going to hurt the dividend investors because a lot of energy stocks pay dividends. And it's going to kind of wreak havoc on that space. So I'm pretty bearish. I'm actually looking as one of my kind of discretionary trades is actually short the energy stock space in the near future because I think it's going to drop about 40-50% and it's going to be pretty swift, which is people don't see it coming. For some reason, everybody's really bullish on energy stocks and they're expecting high oil and all kinds of craziness. I just don't see it. And the weakness in energy and the pattern that's forming on the energy stock charts are very bearish.
Okay, yeah, I will say that is the opposite of what I've heard from some other people. So good to get the contrarian view there as well. Okay, so we have to get an update on what you're doing with Bitcoin. So you said in December, you got into this because it was a can't miss trade. You hadn't done it for a while. You were looking at, I think, 108,700. That was maybe the getting out target. So where are you at now?
Yeah, so Bitcoin's not something I trade very often. This is the first time in like a decade. And when you look at the monthly chart of it, it was just the most beautiful pattern. It had multiple patterns, had a cup and handle, had a bull flag pattern. Both of them point to a huge rally. Not only was the chart looking really good, but it's a herd mentality trade, meaning like the whole world is in on Bitcoin. Grandparents are buying with their credit cards. It's everywhere, right? And I was just saying, this is a pattern that it shows strength. And if it starts to break out, it's going to be headline news and everybody's going to start yelling, it's going to go to 100K. And so I told everybody, I said, listen, this is a quick trade. It's 40% upside. It should go really quickly because the whole world's going to pile in and it's just a bunch of FOMO traders driving it in, like piling in, right? And that's what happened. We got in and we sold at, I used Fibonacci extensions, so we sold our first target at about a 14% gain, and then we closed the rest out at 100,008, 700. And it only went a couple hundred higher, and then it's reversed back down. So it hit a measured move. And so we're back in cash. I don't really care if it goes higher or not. The key with trading is to find a chart pattern, play the trade, get out of the trade, wait for a new picture to be painted on the charts. A lot of people get into a winner, and they're like, well, I don't want to get out. It's doing so well. And they don't sell it. And eventually, like, Bitcoin could fizzle out. It could come right back down. And if the stock market sells off, it still has a positive correlation with the NASDAQ. So if the stock market crashes, Bitcoin's most likely going to crash. And when it pops and shoots straight up, it usually comes straight back down. So that's kind of one of the reasons we don't hold onto stuff. So the key is just to wait for a fresh new trade and see how it turns up.
Okay, so you're done. You're out of Bitcoin.
Done. It was just a one and done. Get in, make the money, move out. It was just play the emotions.
Okay, yeah. Very, very merciless with that one. Okay, and so that was really a speculative trade that you were looking at. Any other speculations that you like right now?
Not really, no. Just the energy space. I'm actually interested in buying an inverse ETF on the energy space. Who knows, in a month or two, whenever the chart pattern unfolds. But that's it. I'm not one for taking big speculation. I'd much rather move into the dollar or move into bonds, something slower than like Bitcoin or something like that that's fast moving. I like slow and easy, because I usually will put all my money into one investment at a time. Whichever asset is the strongest, that meets our criteria, we move in and we trade it. And I like things that move fairly slow, so that if it doesn't work out, it doesn't shock our account.
Okay, it makes a lot of sense. And okay, I'm going to throw in a question. Maybe it's an interesting question. We'll find out. So just because we're here at a conference where we've got all these junior miners down on the floor, I don't think they'll be a fit for you. But when you're doing your technical analysis, looking at the charts, does technical analysis still work for them, or do they move too erratically because they're so small?
They still work. I mean, that's what I used to trade. I mean, I used to be the gold and oil guy, and that was all I traded was gold stocks. So I love the gold space. I own a lot of physical gold. It works on everything. Technical analysis works on everything. The thing with the smaller the company or the stock you go, the more volatile it is. It's a little bit more noisy, and it's not quite as accurate because you have like press releases, you got people pumping and dumping stocks. It depends on how small of stocks you go, right? So as you go from like an index, which is big and stable with a rising or falling tide, to individual tiny little micro caps that have news and newsletters writing about them, right? Like, it creates a lot of noise. So it works, but there's a lot of noise, and it's easy to get shaken out from a rally or a drop. And so it's more difficult for sure.
Okay, yeah, that helps a lot, I think. Okay, so we've covered a lot of ground, I think, quite quickly. But before I let you go, any thoughts you would end on heading into the rest of the year?
I think the key really this year is to be happy with not losing money. I mean, it sounds so boring, but if what unfolds, what I think is going to unfold, it's either you lose 30 or 50% of your wealth, you sit in cash, sitting there fat, dumb, and happy, making 4.5% or 3.5%, or you take advantage of a strategy that can benefit from falling markets. And I'm all about avoid the chaos and continue to earn some interest. We'll let everything reset and take advantage of some of the falling prices. So if the stock market crashes, eventually bonds should come to life. So there's opportunities to be long bonds or currencies. And people need to be, I think, in the mindset it's not about trying to make money this year. They need to focus on not losing their shirt.
And that's because that crash
feels like it's pending. I mean, I've been talking about it for a long time. It hasn't come yet. And the can keeps getting kicked down the road, but eventually it's going to happen. And you really just have to be ready for it.
Okay, I think that'll be a tough pill for some people to swallow. We'll see, but I think a good note to end on. So thank you so much. Really good to, as I said, see you in person for the first time, and hope the rest of the show goes well for you.
Thanks, appreciate it.
Okay, and once again, I'm Charlotte McLeod with investingnews.com, and this is Chris Vermeulen.